Now moving on to the third transaction. So let's say over the first month you made $4,000 in revenue and paid $2,000 in rent for leasing the building, and then both were cash transactions. Now in reality, you're going to have more expenses than just this rent over here. You're going to have to buy ingredients for the ice cream. You're going to have to buy supplies. Maybe you'll be hiring someone, so you'll have to pay a salary or you'll have to pay a wage. But for now, to keep it simple, to illustrate some points, I just kept this single expense of $2,000 for rent. So let's actually look at both of these transactions separately. So let's start off with the $4,000 of revenue. What's going to happen? How is that going to affect the balance sheet? Notice this is the balance sheet from the end of the last transaction. So we got assets, $4,000 revenue, meaning that we received cash, right? Both this $4,000 and us spending the $2,000 were cash transactions. So we received cash. So notice that before our cash balance was $7,000, but now we're receiving $4,000. So what's our new cash going to be? It's going to be $11,000. And then notice that our machine stays at $8,000. And what's going to happen to this right side of the balance sheet? Let's just write out what we have so far. We got a loan of $5,000, and then we got our capital of $10,000. Notice right now that this balance sheet, it's not balancing, because on this left side here, if we total the numbers, we'll have 19,000. If we total the numbers here, we got 15,000. So something's off. We know this here is correct because we received the $4,000 cash. So we have to add something to this right side of the balance sheet. The question is, what do we add and where do we add it? Do we add it here in the liabilities or do we add it here in the equity? Well, notice us receiving this $4,000 cash, making this $4,000 of revenue. It means that our business grew. And if you remember, when we talked about the difference between liabilities and equity, these equity holders here, these owners, the shareholders, are the ones that receive a piece of business growth. They receive a portion of the profits and losses that happen. And so if we ignore this $2,000, we can treat this like a $4,000 profit, right? $4,000 of business growth. And so this $4,000 on the right side, it has to flow into this equity account. So the liabilities would stay the same. These guys are just still getting their interest. Actually, that's another expense that can come up, is an interest expense, but I left that out for this loan of $5,000. So these are the guys that are receiving that portion of the business growth. And so what's going to happen? Now you may ask yourself, so does that mean that this capital here, instead of being $10,000, would it now be $14,000? Is that what we do? And the answer is no. And here's an important point. Capital, this capital here, is based on external financing. So money that came from outside of the company. If you remember, this $10,000 is the money that you initially put in. Okay, so that $10,000 came from outside of the company, while this $4,000 of revenue that is made, notice that that $4,000 is produced internally. It's produced internally. It was produced through the operations of the business, right? From selling the ice cream, the $4,000. And so because it's not an external source of financing, it was internally produced by the company, we create a separate category for it. And actually what I want to name it for now is just revenue. Let's just call it revenue. Now, for those who have gone ahead a bit or have taken accounting before, I know you're going to say revenue doesn't go on the balance sheet, but I'm just going to put it here for now, and then everything's going to come together at the end. So just stick with me for now and just pretend like we're going through this with you having no accounting background. We're just kind of using our intuition of how we should create this financial information. And based on what I've told you so far, how these equity holders are the ones that receive a portion of business growth. If business does grow, it has to go here under this category. And this capital is external money that is brought in by the owners. And then this here, this revenue was internally produced, so we create a separate category. And now notice that the right side of this balance sheet and the left side balance. If we add up all this, 19,000. If we add up all of this here, 19,000 as well. Okay, so what about this $2,000 worth of rent? So this $2,000 of rent, notice that that's not revenue, that's not a cash inflow, that's a cash outflow. So let's call it an expense. How is this going to affect the balance sheet now? Well, notice that both the revenue and this rent expense were cash transactions. And so we have to pay $2,000 cash. It's a cash outflow. So what's going to happen to our cash? Our cash is going to go down by 2,000. So from 11,000, it's going down by 2,000. So now we're going to have $9,000 of cash on hand. So we started at 7, got $4,000 of revenue, but we had to pay $2,000 of expense. So now the cash is at 9,000. And now notice what happens. The total on this left side is 17,000. And so notice that these aren't balancing, so we're going to have to do something on the right side as well. So what's going to be affected on this right side? Well, if you remember, I mentioned equity holders, they receive a portion of the business gains and losses. And so notice that if we just look at this $2,000, let's pretend, let's kind of keep that $4,000 out. If we just had this expense, notice that that's a loss right there for the business, right? We have to spend money, this $2,000 on the rent. And so the equity holders would have to take that loss. And so it's also an internally produced loss. So it's not like we took money outside, took it out of the company for our personal use as an owner, which we're going to do in a transaction in the future. I'm going to show you how that affects things. We didn't take that money outside. This was an internally produced loss. Okay, so this here, let's create another category called rent. And notice that that's going to be a negative number. So let's put this number in brackets to represent that it is negative. And notice that this here is internally produced by the business operations as well, right? This rent here, that's a business expense. And so now notice that everything will balance because we'll have 5,000 plus 10,000 plus 4,000, which is 19,000, but then we're subtracting this 2,000. That's a negative number in brackets. And so we would end up having 17,000 on the right side. And now notice the left side and the right side balance. Now, as I've mentioned, in reality, there's going to be a lot more transactions than just this rent expense over here. You're going to have more expenses. In a month, you're going to have, again, the ingredients, supplies. If you've hired other people, you're going to have wages to pay. You're going to have to pay interest on this loan over here. So there's going to be a lot more transactions. And so notice that if we continue with this kind of format, notice that this equity account is going to get pretty messy because we're going to have all of these transactions listed out. And so notice it's going to start becoming less and less understandable. That quality, remember, we want our financial information to have certain qualities, certain qualitative characteristics. The quality is going to start going down. And especially if this company has been around for a while, let's say you've had this ice cream shop for 4 years, then what? You're going to have all these transactions listed out from 4 years ago as well, mixed in with the recent transactions. So it's going to be a mix of less relevant information and more relevant information. And so you're just going to, this statement here, it's just going to start becoming less timely, and you're, again, just going to start losing quality. If we continue just listing out the transactions under this equity account over here. It's going to be less understandable for the external users. So how can we fix this? Well, to show you visually what we've been doing so far, notice that let's say that this here is time. And what happened was when we had our very first transaction with putting in our $10,000 and then having that $5,000 loan, and then we had the $15,000 cash, let's say that represents that first transaction. And so what was affected? The balance sheet was affected. It was actually created then. And then what happened was we bought the machine. And then what got affected then? The balance sheet. So let's just pretend that these are all the transactions. And then we had revenue. What got affected? The balance sheet. And then we had that rent expense. What got affected? The balance sheet. And then we're going to have supplies, and then we're going to have wages, and then we're going to have interest expense, etc., etc. So notice that each time we're going to have to be, if we continue in this fashion, we're going to have to keep updating that balance sheet. But as we've mentioned here, that balance sheet then starts losing quality, and it's also going to be costly to just keep updating that balance sheet, that single financial statement. So how can we fix this? Well, the first thing we can do is we can introduce some periods. So if you remember, the periodicity assumption says that a company's life is broken down into periods, whether that is weeks or months or quarters or years. So let's say that we break down this timeline here into periods. So let's say we say this here is period 1. Right? Let's not say it's a week or a month or a whole annual period. Let's just call it period 1 for now. Let's keep it general. And then let's say that this here is period 2. So just the introduction of these periods already helps, because now we're going to know that these balance sheets are from this period, these balance sheets are from this period, and so it starts to allow us to have more relevant information in the financial statements because we've introduced these periods. There's going to be better timeliness of the information. However, it's still kind of an issue because even within a period, let's say this is a month, as I've mentioned, there's going to be a lot of transactions, right? There's going to be tons of expenses, and then this revenue, you may not do it for like a month. Maybe you'll start putting revenue daily, right? How much revenue you made in a day. And so even with these periods here, this equity account can start getting messy, and it's still not going to be of the highest quality. It's still not going to be as understandable. And so what we do to fix that issue is we actually introduce another financial statement, and it's called an income And what it's going to allow us to do is organize these transactions within a period. Okay, so let me show you visually again what's going on. Let's say that we have, let's say that this here now represents one period of time, whether that's a month, a week. Let's pretend it's a month, since we're talking about months here for our business. So at the beginning of this month, I erased it, but we had a balance sheet that we started with the at the end of the second transaction. And then what happened was we had these two transactions here within the month. So we had this $4,000 of revenue, and then we had this $2,000 of rent. This was a negative number, so let's just put it in brackets. And notice here, the balance sheet got affected, the balance sheet got affected. And then what happened was at the end of the month, we ended up with this balance sheet here. So this blue, I'm going to represent being the end of the month. So there's only these two transactions that happen within this month. But as we said, updating this balance sheet continuously, it's costly. And so what we do, instead of putting these in the balance sheet, instead of updating the balance sheet, these transactions within a period, we group in an income statement. So notice that this balance sheet now, what's going to happen is we're going to have a balance sheet at the beginning of a period. We're going to have a bunch of transactions within the period that are going to go on the income statement, and then we're going to have a balance sheet at the end of the period. And this diagram here, it illustrates some key differences between these two financial statements, between a balance sheet and an income statement. And I wrote out the general definitions for both over here. So notice the balance sheet, it shows the financial position of the entity at one specific point in time. So at this point in time, and then this point in time here. While an income statement, it shows the performance of a company during a period of time. So it groups a bunch of transactions during a period of time. And that is a key difference between these, a very important difference that I'm going to keep coming back to. And so the two words that are important is this balance sheet, it's one specific point in time, while the income statement is during a period of time. So sometimes you'll see this balance sheet called the snapshot of a business, the snapshot at one point in time. And the balance sheet is created in between transactions. Okay, so if we extend this a little bit, extend this diagram, let's say this is the life of a company. Let's say this is the beginning of period one. You're going to have a balance sheet there. And then you're going to have a bunch of transactions within that period. And then what's going to happen is you're going to have a balance sheet here at the end of the period. So these are not transactions, they're in between transactions. These transactions here, they're going on the income statement. Then you're going to have a balance sheet at the end of this period, which is also going to be the balance sheet at the beginning of the next period. And then you're going to have a bunch of more transactions in the next period. And then these transactions here are going to go on the income statement. And then in between transactions, you're going to update that balance sheet at the end of this period here. So notice again, this balance sheet is in between this transaction and that transaction right there. Right? So it doesn't represent a transaction. That's what we were doing before. These transactions, we kept on updating the balance sheet. But now we're putting the transactions on an income statement, and the balance sheet is going to be updated periodically only, right? It's going to be at specific single points in time, while the income statement is grouping the transactions or showing the performance of a company during a period of time. And I haven't gone through the actual format of an income statement yet, but we're going to do that soon. But definitely just want you to understand the difference between both of these financial statements and how they work in regards to time. So now what I'm going to do is I'm actually going to redo this third transaction here, but I'm going to properly deal with it, show you how to properly deal with it, and I'm going to introduce the income statement and show you how it fits into all of this. So notice I have that balance sheet here written out like we did the first time for after the second transaction when we bought that machine. So I'll be referring to this, and then we'll make the new proper balance sheet after this transaction. I'm actually going to add a little bit more detail here this time. Instead of saying over the first month, I'm going to add an actual month. So let's say in September 2012. You made $4,000 in revenue and paid $2,000 in rent for leasing the building, and both were cash transactions. So if we show this over a timeline, notice that this here is going to be the beginning of September, and so we're going to have a balance sheet, and that's going to be September 1st, which is actually this balance sheet over here. And then what's going to happen is we're going to have two transactions during September. So we're going to have that revenue of $4,000. We don't know what exact date it's going to be. Let's just say that revenue is throughout September. And then we're going to have that rent that we got to pay for $2,000. And then we're going to have a new balance sheet at the end of the period, September 30th. So the reason why I want to bring in some specific dates here is to further show you the format of a balance sheet and an income statement once I introduce it. But for a balance sheet, remember, it's at one specific point in time, and this balance sheet here is for September 1st. And so if we were to add titles to this, let's say that your company, let's pick a simple name. Let's say it's called Ice Cream Incorporated. Right? This is where the company name would go. And then we want to specify that it's a balance sheet. So we would write balance sheet over here. And remember, a balance sheet is at one specific point in time. It's a snapshot that shows the financial position of the business. And this snapshot is September 1st. So over here, we would put that date. So September 1st, 2012. Okay, so that's the proper format for the title of a balance sheet. Company name, balance sheet, and then that single date that you are looking at. So now what we're going to do is we're going to take these two transactions here and put them in an income statement. And an income statement, its very general format is you'll have revenue, you'll have expenses, so you'll be subtracting the expenses from the revenue, and then you'll end up with net income. Sometimes you'll see this called profit, sometimes you'll see this called earnings. I'm going to use net income. Right? And it's not just one line. As we get more and more detailed in the course, you're going to see that sometimes there's going to be multiple streams of revenue. There's going to be multiple expenses, different categories, subcategories of expenses. But for now, we only have one source of revenue and then one expense. So the revenue, actually, you know what? First off, let's create a proper title for this, like we did with the balance sheet. So you would put the company name. You would put what statement it is. It's the income statement. And then over here, remember, what's the difference between an income statement and a balance sheet? A balance sheet is at one specific point in time, while an income statement is during a period of time. And the period of time that we're looking at is September. So you can say for month of September over here. Another common way that this is formatted, sometimes they'll write for month ended. And they'll put the date of the end of the month, so September 30th. Right? So I just put for the month of September, but you could put for month ended September 30th. The reason why they do this is because sometimes periods aren't going to end on a nice date. Notice that September 30th, that's right at the end of the month, but sometimes companies can maybe end their months on the third day of the next month. So this could be for month ended October 3rd. So from September 4th to October 3rd, that would be a month. Or sometimes you'll see for year ended, and instead of having December 31st, which would be a nice finish to a year, they'll have maybe like January 3rd or something like that. So that's why this format is sometimes written instead of just saying for the month of September. We could say for the month of September because that's what we're dealing with, but again, if it had a weird ending, or maybe the months are from the 15th to the 15th of the next month, then you can't just write for the month of September and October, or for half of September and half of October. That would be kind of weird. So you would just write for month ended and then the end October 15th. But I'm just going to keep it for month of September right now. Revenue, $4,000, so that would be here. And then we have the expenses. We can write rent here. I'm just going to keep it as a general category for now of $2,000. And so what ends up being our net income for September? Well, it would be $2,000. This $4,000 of revenue minus this expenses of $2,000. We get net income. Right? So these are the general elements or categories for an income statement. Sometimes you'll see that word elements being thrown around. So assets, liabilities, equity, those are the elements of a balance sheet. Revenue, expenses, net income is the elements of an income statement. And if you remember, we created an equation with the balance sheet where assets equals liabilities plus equity. Well, we can create an equation for the income statement as well, where revenue minus expenses equals net income. And as I mentioned, I'm going to come back to equations in future videos, and I'm going to go into more detail on how they all relate to each other. But every time I'm introducing a new financial statement, I'll introduce the equation, the respective equation as well. Now let's create the balance sheet at the end of the period, at the end of September. So notice that I have a balance sheet here that's not filled in. We got the three elements, assets, liabilities, equity. And notice that this date here is for September 30th, 2012, the end of the month. Now, September 1st, 2012, remember we had cash of $7,000. But notice that that changed because both of these transactions, they were cash transactions. So the revenue, we received $4,000, so we would add $4,000 to this, but then for the rent, we had to spend $2,000. So we add $4,000, subtract $2,000, and we end up getting cash of $9,000 here. And then we have that machine on our books still, that's $8,000. The loan didn't change. That was $5,000. The capital, that paid in capital, didn't change. We didn't put any extra money into the company externally. Remember, this is external financing here, this capital category under the equity. But how are we going to have this gain of the business? Notice that this $2,000, positive $2,000 of net income, that's a gain of the business. And remember, the equity holders receive the gain. And when we did this balance sheet initially, what we did was we put the revenue and the expenses here. But now that we took them out, we put them on a separate financial statement, the income statement. What are we going to put here? Well, what happens is this net income is actually going to flow into the equity. So instead of having two categories that net out to 2, we're just going to take this 2 and put it directly there. And we put it into a category called retained earnings. And the retained earnings in this case, because there was no retained earnings before, the retained earnings are just this $2,000 of net income. So remember, this capital here under the equity, this is external sources of cash, while this retained earnings was created by the business operations within the business. So you could think of that as being internally produced gains. And a more specific definition for retained earnings is accumulated net income over a company's life. So what's going to happen is in future periods, we're going to have income statements, and this net income is just going to keep flowing to this retained earnings, right? So the retained earnings is going to be the accumulated net income from a bunch of periods over the company's life. So if you have gains, it goes to retained earnings, and then also if you have losses, this net income here can be negative as well, and that would come out of retained earnings. So accumulated net income or accumulated gains and losses over a company's life. One thing I want to mention, we're actually going to cover it in the next transaction, is there is another thing that affects retained earnings, and that's something called dividends. And I'll explain what those are in the next transaction. So really this definition should be accumulated net income and dividends over a company's life. But because we haven't covered dividends yet, I'll just leave it at net income for now. And so this here ends up being the final balance sheet in its proper format. Right? So the difference is, instead of having this revenue and expenses here listed out, we got one category. We put it all into one category, retained earnings. And so notice that it's more nicely organized now. Instead of putting everything onto one financial statement, we got two financial statements to work with. And also notice that everything balances on this balance sheet. Notice we got 17,000 on this side. And then if we add up all this, 5,000 plus 10,000 plus 2,000, that would be 17,000 as well. So left side and right side balance for the balance sheet on September 30th, 2012.